Good morning, everyone. My name is Disha Rambajan. I'm a TV news anchor, senior multimedia journalist, and businesswoman. Welcome to the 13th episode of Scotia Insights. So it's my pleasure to join you for today's thought-provoking discussion. So now allow me to introduce to you our panelists. Joining us from Toronto, Myles Zyblock. He's Chief Investment Strategist at 1832 Asset Management L.P. Scotiabank. He will explore the fallout from the pandemic, share key insights, and a review of international markets. He'll also provide recommended investment strategies. Myles has been a part of the asset management arm of Scotiabank since 2013, working closely with the portfolio management team to guide and oversee 150 billion in assets invested globally. He also serves as lead portfolio manager for a number of funds offered through Scotiabank's retail mutual fund business. Myles is a recognized strategist in North America, regarded for his investment insights that blend the tools of finance and psychology in order to capture major inflection points in financial markets. He has over 20 years of experience in guiding and advising on asset location for a diverse set of institutional and retail advisors across North America, Europe, and Asia. Prior to joining Scotiabank, Myles held a number of similar roles, including Chief Investment Strategist at a large Canadian financial institution, the head of the US and global equity teams at a privately held US financial institution, and led the global equity sector strategy team at a major independent investment research company. Myles has an MA in economics from Queen's University and is a CFA charter holder. Now, also on today's panel, we've got Christopher Clarke. He's head of investment management, Scotiabank Trinidad and Tobago, and he will share an overview of the domestic economy, its implications for local investment markets, and recommendations for a TTD investment strategy. Chris joined Scotia Investments as head of the investment management team in Trinidad and Tobago in 2018. He's responsible for oversight of over 3 billion TT in assets under management investment invested across both local and international markets, inclusive of Scotia's 2 TTD mutual fund portfolios. Chris is a respected expert in the local industry with over 10 years experience in investment management at leading domestic financial institutions across mutual funds, pension plans, and insurance. He holds a BCom in economics from the University of Guelph and an MBA in international business from Ryerson University. So without further ado, I'll now hand you over to Myles to kick things off with the international perspective. Myles?
Thank you, Disha. Good afternoon, everybody. It's a pleasure to join you on the call today. I'd much rather be there, of course, in person, but given the circumstances, this is the best I can do for now. Hopefully, I can make the trip to see you in your lovely country in the not too distant future. My part in today's presentation is to provide you with some insights about the global economy and events that are shaping the outlook for financial markets. I hope from this you can take away some helpful ideas, not only for your own businesses, but for your savings, of course. So let's begin with slide 2. So as you know, we're all very well aware, the world was first hit by a health crisis earlier this year. And sadly, almost a million people have lost their lives as a result of the pandemic, and perhaps millions more are struggling with the lasting health impacts of the virus. Initially, schools were closed, businesses were closed, and many countries, they locked down their borders in an attempt to control the spread of the virus. The chart on the right, you see, shows world GDP growth back to 1871. And you can see that the resulting sudden stop in economic activity has led to one of the deepest and sharpest global economic recessions in history. So moving on to slide 3. In what can only be described as a panic. Global policymakers flooded the system with support. Fiscal policymakers have spent literally trillions of dollars on income supplementation, loan guarantees, and tax deferrals. The G4 countries plus China, that's a very large share of world activity, are expected to run a record deficit, as you see on the left chart there, of 17% of GDP this year alone. And I think it's going to end up being even larger than this because more stimulus is on the way. Washington, for example, is currently battling over a fresh $1 to $2 trillion follow-up stimulus package. And central governments or central banks have been equally generous. For most of the world's major central banks, they started by slashing their interest rates to 0% or very near 0%. They followed this up with trillions of dollars, in fact, of direct purchases of government and corporate bonds from the secondary markets in order to hold interest rates at a low level. Every indication tells me at least that there's no rush to raise these interest rates anytime soon. Just yesterday, in fact, the Federal Reserve, the U.S. central bank, signaled that interest rates are probably going to stay near 0% for at least the next 3 years. On slide 4, the next slide. So, policymakers, they've been acting as a bridge for the private sector. And while they've been doing that, people are starting to make adjustments in order to deal with this new way of life. Masks are being worn, very timely data from Apple on the left here. Shows that people are moving around more. This is based on Apple's geolocation data, and more movement means more commerce, and we're seeing this in global production data, which looks like it's improving. Consumers are starting to spend again, not just at Amazon, and housing markets in North America are coming back. The economics community, if you see on the table there, the economics community does expect activity to snap back with growth strengthening well into 2021. And for the world, we could see GDP expand by, say, 5% in 2021 after having perhaps declined by upwards of 4% or more this year. And as you see, those gains are expected to be fairly broad-based. I have Trinidad and Tobago in there just for your interest. So now moving on to slide 5, notice that global equity markets have been rallying after having declined by 35% between mid-February and late March. They've not only clawed their way back, but have recently touched new all-time highs. U.S. equities have been leading most other equity markets. I think the mountain of stimulus injected by policymakers earlier this year it initially encouraged investors to dip their toes back in the water. But as you can see on the table in the right, an expected and widespread, really, earnings recovery, I think, should help carry the markets higher into 2021. I mean, some of these growth numbers are expected to be 30+% in 2021. Of course, that is partially due to a low base because earnings are so poor right now, but in fact, activity is improving and should support these earnings profiles. Now on slide 6, it's not only, as you can see here, been equities that have been in rally mode. Most other growth sensitive assets, such as corporate bonds on the left and many of the commodities on the right, they've been lifted by an improvement in the economic outlook. With respect to commodities, again on the right side there, we've seen capacity rationalization among the producers, and that's helped to set a higher floor under prices, and now that the demand outlook is stabilizing, somewhat higher prices, I think, for the industrial commodities are likely to appear over the next 9 to 12 months. So moving on to slide 7. The U.S. dollar, it's been a casualty of this budding global recovery. You can see on the left that the value of the trade-weighted U.S. dollar has been sliding lower in recent months. Many people believe this is because the U.S. has done perhaps a poor job at containing the virus, so they have more economic vulnerability. Others think that it's tied to election uncertainty with the upcoming election. In my opinion, it's really because the demand for safety is waning. The U.S. dollar is considered a safe haven among currency investors. It tends to perform best when the world is facing important economic challenges. On the right side here of this slide, this shows the value of a basket of commodity-based currencies, including the Australian dollar in that line, the New Zealand dollar, the Norwegian krone, and the Canadian dollar. And this basket of currencies has been strengthening against the U.S. dollar, just as commodity prices, which are the blue line in this chart, have begun to firm. Currency investors are moving towards riskier, or let's call them more cyclical currencies, as a result of, in my opinion, the budding recovery in global economic activity. So on slide 8, you might think when you read the news headlines that I probably lost the plot or something, that the world is in terrible shape, that equities have rallied too far and too fast, and we should be really placing our savings under the mattress. But let's just look at what happened earlier this year. The chart on the left side shows that cash stockpiles started to build in the first part of the sell-off in equity markets. And it continued to build well after the low in equity prices. Those people who piled into cash, whether because they were scared or whatever, will never get their returns back. Most, as you see, sold at or near the bottom, and they locked in those losses. Timing is really hard. The market is up by about 4% this year, and that's after having fallen by 35%. On the right, just have a look at the right side chart here. If you simply missed the 5 best up days in the market this year, your equity portfolio would be down 18%, not up 4.5%. If you missed the 10 best up days, you'd still be down 33%. So like I said, timing is very, very hard. So let's move to slide 9. And the thing that's important to remember about equities is that they're a volatile asset class, that corrections are very normal. We typically see a correction of, say, 5% or more 3 times a year in global equities. We see a correction of 10% or more once a year. Something on the order of 20% or greater is experienced by an equity investor every about 6 years. We never know with certainty when any of those are going to happen, but look at the chart on the right here. It shows the calendar year returns for the stock market in blue for each year back to 1980. And in the red, we show the largest sell-off that occurred within each of those calendar years. So what we're showing here is 41 years of return data. And the typical, let's call it biggest correction, the average of the biggest corrections in each year since 1980 has been 13%. And yet the market has only been down in 9 of those years, said differently, 3/4 of the time, the market has finished the year in positive territory. So let's move on to slide 10. It's important, in my opinion, to have a strategic investment plan in place, one that's consistent with your risk tolerance and your return objectives. And if equities are part of that plan, then stick with them. Knowing full well that there's going to be periods of time when things are challenging. And the same goes for bonds or whatever else is in your diversified portfolio. And why is sticking to the plan so important? And I think this slide shows why. So what we're showing here is the annualized returns in gray over the past 20 years for almost every different asset class you can imagine. So those are annualized returns since 1999, all sorts of equities, bonds, and commodities. And I've highlighted the blue bar there, and that's the return for the diversified portfolio of the average investor. And this is based on real return data here. It's an actual return of the average investor. And the typical investor's portfolio has done worse, as you see, than almost everything that makes up the portfolio. And how is that possible? How can you have a portfolio with a return that's worse than just about everything that makes up the portfolio? I think it's emotional investing. People are, buying certain asset classes when they should be selling them, or selling them when they should be buying them. And the point is that with a strategic investment plan, there's no need to invest based on what the bond market or the stock market is doing today or what it did yesterday. There's no need to act, according to emotional fear or greed. You have a long-term plan to guide you. So let's move to slide 11. Most of the data that I've discussed informs me that we're past the worst for the economy, that equities, corporate bonds are probably going to outperform safer assets such as government bonds and cash. And does that mean that we should be all in the equity market or the corporate bond market or even say commodities? And my answer has always been, and it continues to be, no. A tilt towards these favorite asset classes is justified, but this is very different than being all in. This slide looks pretty busy. What we're doing here is we're color coding the different asset classes, and what we're also doing is rank ordering their performance from best to worst in each calendar year since 2000. Leadership across these asset classes varies from year to year. There's a lot of changing places between the leaders and the laggards. So just focus on, let's say, the emerging market equities. That's the brown boxes in this slide. You can locate them as the brown boxes. And these emerging market equities, we're at the top of the heap in 2017. Very top of the heap, 37.8% returns. Lo and behold, in 2018, they were at the bottom. And then 2019, they were in the middle. So again, there are big swings in the performance of many of the asset classes from year to year. And as I've really said over and over, that timing is very hard, and diversification is key. It's an admission that the future is uncertain. So while, like I said, we believe we're in the early stages of a cyclical recovery and encourage a corresponding tilt in the portfolios, this is not an all or nothing position. I think a well-diversified portfolio, which in this busy chart, let's call it, is shown in the dark gray box for each year. It doesn't get us into the pole position in any given year. That's what diversification does. That's the cost of diversification. The benefit is that you aren't going to be found at the bottom of the performance ladder. And being at the bottom too many times is what eventually puts, I think, many people's investment goals out of reach. So with that, let's go to slide 12. And you should really be making asset allocation decisions based on what you can live with. and less about what's happening in the stock or bond market at any given moment in time. Like I said, nobody knows the future with 100% certainty. I am a true believer that a well-diversified portfolio that's consistent with one's objectives and risk tolerance will offer the highest odds of achieving long-term financial success. It's kind of shooting right up the middle in a very healthy way. So on the final slide, I'm going to offer you sort of a summary of what I've been talking about. So to review, the world economy is climbing out of recession with the help of really unprecedented policy stimulus, both fiscal and monetary policy. Ongoing economic growth is a backdrop, I think, that's favorable to cyclically oriented assets like stocks, corporate bonds, and industrial commodities. That being said, many uncertainties still linger. The Northern Hemisphere is going back to school, and a second wave for the virus is a real possibility. Meanwhile, the U.S. is going to hold an election that has all the makings, let's call it, of a soap opera. And that's why it's incredibly important to have a strategic and diversified investment plan in place, and one that's consistent with your return goals, your risk tolerance. I think doing so takes away the need to time swings in the asset classes. Effectively, diversification across various assets removes a lot of the guesswork from the investment decision-making process. So I think I've said enough. And with that, I'm going to hand it off now to my colleague, Christopher, who will offer his expert insights on the local economy.
Thank you very much, Myles. Some real pearls of wisdom, I think, contained in that one. Everyone likes to chase returns, and I think you really drove home the point and the value of a well-diversified portfolio, and not trying to be at the top of the pile by being overly active, at every twist and turn in the market. I think that's a real pearl of wisdom for our local investors to take away. So thank you very much for visualizing and really driving that point home. So hi everyone, my name is Chris, and I'm just going to be taking you through an outlook on T&T, a quick review of the economy, and a look at our markets. So just quickly and briefly, a quick look at COVID. We all know we had some initial successes in the containment of the spread of COVID-19, but Trinidad is now well into community spread. As at this morning, I believe we were up to about 3,300 cases of COVID, and unfortunately up to about 55 deaths. Likewise to what we've seen in the international markets, in international countries, we have actually seen some extraordinary fiscal and monetary policy measures being implemented right here at home in T&T. So we've seen things like interest rates cuts. And on the right chart here, you'll see there's a number of financial relief measures that the government has put in place to try and stem and mitigate the impact of the economic shutdowns that we've experienced. COVID is approximated to cost T&T about $10 billion, all said and done. This is in both lost production and economic revenues, as well as the cost to the government in putting forward these financial relief measures. If we take a look at T&T over the last few years in terms of its economy, I don't think it's a secret that we've been in near recessionary conditions over the last few years. This has really been brought about by a collapse in energy prices, and the chart on the left, you'll see the minus 6.3% GDP growth we recorded in 2016. While we've been recovering slowly, it's been negative growth or economic contraction each year since then. We also see the charts on the right that our natural gas production has actually fallen off a bit. We were at a high of about 4 billion cubic feet per day through to about 2016. We're now down to about 3. And our crude oil output has actually been declining quite rapidly and quite steadily over the last decade or so. Over that period, we've seen Trinidad's credit rating also slashed from an A- in 2016 to BBB minus as it stands right now by S&P. So the COVID shutdowns have likely exacerbated a number of pre-existing economic challenges the Trinidad economy has been facing. As a result of the decline in energy production and prices, we've also seen a decline in our FX reserves. We know that Trinidad runs a pegged rate, and in 2016, on the back of that immediate or sharp downturn in energy prices, we did actually see the new government administration at that point in time come and move or adjust our fixed peg from the 6.35 rate that existed for many years before. We are in arguably a worse economic situation at this point in time. So it's just something to keep in mind. Do we think that this policy or another exchange rate adjustment is due in the next 6 to 12 months? We here would not be surprised to see something like that unfold. But having said all that, there are positives on the horizon. We can see in the chart on the left here that Trinidad's natural gas reserves as well as production have actually been rebounding since 2016 through 2019. And Trinidad is actually poised to recognize economic growth next year of about 2.6%, albeit this is from a lower base, but this would actually represent the highest rate of growth in our local economy since 2010. 2010, we did about 3.5. Also favorable is that the natural gas increase in production is going to coincide with an estimated increase in natural gas prices. So the EIA, or the Energy Information Institute in the US, is actually projecting estimated natural gas per MMBTU price of $3.19 or $3.19 in 2021. That's a 47% increase over what was recognized or what the average estimate is for 2020, which is $2.16. On the back of this, we also know we have a number of production facilities coming online over the next 12 to 24 months. We have Mapatal and Cassia compression project from BP. We have the Ruby field that's due to come online from BHP. And we also have some onshore discoveries coming into production from Touchstone Energy. Further to that, we've actually seen more recently over the last week, BHP just recently announced that they will be drilling their deepest ever well in Trinidad and Tobago to the depth of some 20,000 feet. So I think this is a positive boon for the economy going forward, in that we are still attractive enough to attract foreign investment and energy production, even in the low price environment we've been seeing over the last few years. Now, let's just quickly turn from the economy to the markets. And I will just be at pains to say here that the economy is not the market. And I'm going to repeat that for the folks in the back, because this is a very common misconception. The economy is not the market. So as much as we've said that the economy has been contracting over the last few years, over the last 5 years, the T&T Composite Index has actually done a total return of some 42%, which is not too shabby, all said and done. The market has been driven higher by IPOs, APOs, and M&A activity. And it goes to show that even in our local market, we do have companies that are regional and have international operations. So while you're investing in a Trinidad company, you're actually diversifying in terms of the operations from which you're exposing your investment to, which is a positive for you, especially in our current environment. Taking a slightly deeper dive into the construct of the TT market, we know that the TT market is really made up of two major indices. There's the All T&T index, and there's the cross-listed index. The All T&T being made up of our local companies, the Republic Banks, the FCBs, the Massey's, the Anson McCalls, and the cross-listed index that's really right now mostly comprised of some Jamaican names. Grace Kennedy and NCB come to mind especially. So the chart on the left shows the disparity between the performance of those two indices on a year-to-date period. The All T&T has actually recovered quite significantly off its 14% year-to-date low. It's now down only about 4% year-to-date. And that's really been pushed higher by, if you can see on the right-hand side, some of the bigger cap names are actually positive year-to-date. and then someone like Massey is down, less than 2%. So despite everything that's gone on, these stocks continue to perform pretty admirably. The Jamaican names, however, have fallen off down about 20%, and they have not seen that kind of recovery so far. So just something to take into consideration, that the headline that you might see of 8% decline, not all companies and not all stocks are created equal. So you really do need to dig a little bit beneath the hood to kind of understand what's driving the market and what you might be missing just by reading the headlines alone. So now taking a quick look at some relative valuations between those T&T and those cross-listed names, we'll see that with the earnings declines that would have been expected across the board, having lost a quarter basically this year, we see that all the PE ratios, all the valuation ratios have actually shot up a couple times over. So the TT Composite Index, or the TT All Index, the 3-year average was about nearly 14 times earnings. Right now it's closer to 17 times earnings. When we compare this, however, to the cross-listed names, they're almost right in line with their 3-year historical average, which suggests that they are actually right now cheaper than their all T&T peers, and that they may be a spot that there may be some value existing. We see a similar sentiment shown by the PB or price book ratios. All the while, the dividend yields of these companies are actually sporting a higher yield than our all T&T compatriots. So that's just, I think, an interesting takeaway, that you do need to dig a little bit beneath the hood to try and really eke out a little bit of value in our marketplace, right? So having said that, and just getting into a quick conclusion here, what can we do? How can we protect ourselves in this new uncertain post-COVID environment? Well, definitely one thing, I think you want to stick with strength. As we showed in the charts gone by, the large cap equities have actually rebounded the strongest from the April lows. They have relatively strong balance sheets, and so they've been able to weather this economic storm a little bit better than some of the smaller cap peers that have lagged. They also have healthy cash flows, which will enable them to kind of maintain or better maintain their dividend payouts. We also think horses for courses. At this point in time, we're stuck in something of a low growth environment, as well as we've seen government policy has driven changes in consumer behavior. So there were some companies that were open, deemed essential over the last few months, while others had to close. That is going to show up in their financial results going forward, as well as in a post-COVID environment where discretionary spend may be constrained by some local consumers. You're going to want to take that into account when picking your investments going forward. Evaluate new opportunities. The significant slide down in some equity prices might be presenting right now actually an attractive entry point. So we know that some of those Jamaican names are still down 20% year to date. So does this provide an attractive entry point for longer term investors who are able to weather a little bit of risk in the short term to try and eke out some upside? And last but not least, and tying it right back into what Myles had to say previously, is to diversify. The pandemic risk is still exists in both the local and the global economy. And so investors should probably seek to diversify across names and asset classes to reduce downside risk as uncertainty persists over the short to medium term. So with that being said, I want to thank everyone again for being here and joining us this morning. And I'll turn it back over to Disha, who can take us through the Q&A section.
Well, thank you so much, Christopher, and thank you, Myles, for your very insightful presentations from both the international and local perspective. And we hope that our audience feels confident about our advice and expertise as we all continue to adjust to this very unique time. More importantly, we hope you feel inspired to take action. So now I'm seeing some questions in the chat, but before we get to those, we'd like to address the questions that a few of you submitted via email. And the first one is actually from Myles. So the question is, we're seeing global stocks at record highs, yet the global economy is still feeling the impacts of the virus and shutdowns. How do you explain the disconnect between the two? And is this cause for concern for investors?
Thanks for the question, Disha, and whoever had generated the question. So the one thing you have to understand about financial markets is they tend to be forward-looking. And so when you see stock prices rising after, as I already explained, a mountain of policy stimulus, it's investors looking towards, 2021 and beyond, saying that, governments have basically, provided the spark to get the economies going. And this is likely, and we're already seeing it. House prices, housing activity, production, it's already starting to recover. So the markets are discounting mechanisms, meaning that they are behaving on what they expect the future to behold. And like I said, I'm not sure it's a disconnect. I'm in agreement as well that the economies and earnings are likely to improve in 2021. So we're seeing that reflected in prices today.
Right, and now we have our next question. Unless Christopher would like to comment on Myles's answer, is there anything that you would like to add to that?
Yeah, I think we're seeing a similar phenomenon in the local market. We did speak about the increase in the PE ratios that we've seen in some of the all T&T names, especially the price appreciation we've seen in some of the large cap. So I think that investors at this stage are looking for the opportunities to enter these names at a slightly lower price, and expecting that they will return to growth in the not too distant future. And so, they're getting in while the going is good. So I think that we've seen some opportunistic investing on the local market, and my hat's off to everyone who's taking part in these rallies.
Well, thanks, Christopher. And let's head back over to Myles again for another question. Will the outcome of the US election in November, one way or the other, have any significant bearing on US markets? And what might you be looking out for or expecting?
So that's a really good question. And let me just roll the calendar backwards or in reverse for a second. I don't know if anyone remembers, but the prognosticators at the time 4 years ago basically said that if Trump got elected, the world was going to come to an end. And in fact, the night that President Trump was elected, US markets were down 5%, futures markets were down 5% in the overseas. And by the morning, we were back to flat. And lo and behold, here we are today. So for people to say that, the election is going to have, look, to me, it's a soap opera. It's great if you're, a newspaper article writer, you have a lot of stuff to talk about, but ultimately it comes down to, is anything with respect to the election going to ultimately impact the fundamentals of American or global companies? And I think right now, both, you can agree or disagree with the policies, and that's not a question for markets. That's your personal preference and why you'd vote for this guy or that guy. But when it comes to the markets, is there any changes out there likely, whether it's a Democrat win or a Republican win, that will ultimately impact the fundamentals of companies? And I don't think so. I mean, right now, Democrats and Republicans are not arguing about spending less. That isn't even the discussion. They're both arguing about, let's spend a lot of money. It's about how much money are we going to spend. So, we can talk till we're blue in the face about what the election might mean, but ultimately the policies in place are pretty consistent across both sides of the aisles, in the sense that both parties seem to understand that the economies are strained and they're trying to do their best to get us back on track. So could we see, a day or two of something happen? Sure. I don't know. But as an investor, I say there's nothing in the works on either side that's going to fundamentally alter my view of the corporate earnings trajectory.
Thanks, Myles. And the next question is for Christopher. What's the best way to hedge my T&T dollar exposure?
Ooh. Okay, well that's a good question, an interesting one also. I think on the local market, we do actually have a couple interesting plays available. We do have some closed-ended mutual funds that have large USD components to them. So you'll actually be investing in TTD, but getting a lot of US dollar exposure. So if there is a depreciation, that you would see that the value in your TTD would, the nominal value in TTD would increase. That's also true of a number of open-ended mutual funds available on the market. We also have NGL that trades on the local market. That is basically a completely USD company. All their cash flows are in USD. So you'd expect that their earnings in TTD or their dividend payout in TTD would increase if there's a depreciation in TTD versus US. So those are just a couple of ways that you can seek to hedge against the potential for depreciation in the TTD going forward.
Okay, thanks, Christopher, and thanks so much for your answer. And let's get to the chat now. And we've got a question coming in from Marsha Worrell. I'm just going to read it out on her behalf. And it goes, perhaps Myles can tackle this one. Do you think that with the different things that are going on in the US, elections, protests, pandemics, etc., would the economy get better or worse? You may have touched on this a bit before.
So that's a good question, and it's a pretty sad state of affairs when all we're doing is reading about the riots and about the unrest, and like I said, that's I don't think, well, if you want to take a really interesting view, when you break windows, it adds to GDP, and that's a true statement. So at the margin, the riots are actually adding to GDP. When you burn down a building, the building disappearing doesn't subtract from GDP, but building a new one adds. I mean, that's not a very nice way to look at the world. But look, I don't think that the elections or the social unrest is enough, large enough yet, and hopefully never is, to materially impact the economic outlook for the U.S. economy. You got to remember that the U.S. economy is a very diversified economy, and it's massive. It is unbelievably massive. So a riot, pockets of riots here and there, I don't think really does much to shut down this behemoth called the U.S. economy. So again, that is not really altering my view about financial markets or the likely trajectory for corporate earnings. I believe that S&P 500's earnings hit their worst in the second quarter reports, and they're going to improve from there. So Q3 and Q4, you can expect better earnings, and I think that will be the case, even after considering the impacts of the election and some of the other things that are going on. Thanks, Disha.
All right, thanks, Myles. And we've got another question here. Perhaps either Myles or Christopher can tackle this one. It goes, we've seen technology stocks rebound at a much faster pace than the rest of the market. Do you expect them to keep rising, or are we now in a bubble that's at risk or bursting?
I can maybe start with that. So, are there certain pockets in technology that look elevated or expensive? And the answer to that is absolutely yes. Is it a bubble? I'm not sure that we have a broad-based technology bubble. There's no indication of that. Just think back to the last technology bubble where you had the whole sector, never mind just one or two companies, but you had the whole sector trading at 50, 70 times, not earnings, sales. And that was pretty common. And a lot of companies did not have earnings back then in the dot-com bubble. So it really was a classic investment mania. Today, you are truly seeing a huge demand for companies that can put up some sort of earnings growth and or top line growth in a world where growth is scarce. And in fact, when you look at the supply of companies that are able to grow, revenues, for example, in excess of 10% per year, that has been a shrinking number of companies through time. Actually, not just over the last couple of years, through time. So growth scarcity at the company level has been increasing, and that's why the demand for these growth companies has been so great. Again, are there pockets of excess? Yeah, I'm not going to name names, but I'm from Canada, and I think about snow, and there's an IPO called Snowflake, which might be a little bit. It's a cloud-based company. Sure, there you can find them. And I'm not going to deny that, but I don't think we're at the stage of a broad-based bubble now. I think the companies are generating absolutely fantastic earnings, not only relative to their peer groups, places like industrials and energy. They're doing much better, these technology companies, and so I think there's fundamental support to this story. But as an investor, we have become more selective in the technology sector because, like I said, there are pockets of excess.
Thanks, Myles. And if you don't mind, I'll just tag along a bit. The technology companies are actually able to reach, I think, a much broader audience than, I guess, say, more localized companies that actually produce physical output, products and services that you may need to receive at a point of sale. So even here in Trinidad, we know that the online shopping, the Amazon shopping boom, it might just really be getting started, as people move more and more of their day-to-day behaviors online, especially with the new social restrictions we have in place. So I definitely think that there is a shift towards these kind of companies and the services they provide, and perhaps paying a premium for them is warranted at this point in time.
One of the things I'd like to add is that, the flip side to that technology story, and given the context of the virus or the pandemic, is that, many companies around the world have been struggling quite severely. I mean, we say that, the stock market is up 4 or 5% this year, but there's large swaths of industries that are down still quite a bit. Whether you're talking about, casinos, entertainment and leisure companies, airlines, I could go on and on, plain vanilla brick and mortar retailers. I mean, these companies are definitely struggling still because, of the social distancing and how that impacts their operations. And one thing I will say, though, is that are they dead forever? I doubt it. We have thousands of very smart people around the world looking for some sort of solution. I am very optimistic that when the world has never put in a bigger effort to find a solution to a problem, and I am very optimistic that we will find a solution. And ultimately, let's call it a vaccine. I'm not sure what the solution will be, but let's call it a vaccine that is distributed worldwide. I think that could unlock that, the inverse of this technology thing is that could unlock a lot of bottled up value that we're seeing in so many companies that are, hotel industry, et cetera, that have been impacted by the virus. So that's the other thing you have to keep your eye on. Your eye on, the fact that, if you're a longer term optimist, which I am, and I truly believe in human ingenuity and the power of human ingenuity, the idea here is that, a breakthrough towards, taking steps towards managing this pandemic better is going to release a lot of value bottled up in some of these other areas. So keep that in mind. And again, that comes back to my point of don't put all your eggs in one basket. Everyone's talking about technology today, but having a couple pennies or whatever you want to call a couple bucks in these other areas that people have left for dead might prove to be a very rewarding longer term idea.
And this is our final question. So yesterday, the Federal Reserve indicated that it would be holding interest rates in the US at the current lows, at least for the foreseeable future. What impact do you expect this to have on stock markets that are already trading at highs?
Disha, who would you like to, both of us, have a go at this question?
Perhaps, Myles, you could take this one.
Okay, so effectively, this is more of the same. The interventionist policy behavior that we've seen over the last 10 or 15 years, this is just an ongoing extension of that behavior. And what policymakers are doing, part of what they want us to do is to they want us to push out the risk spectrum, to take more and more risk. So basically, they're doing that by taking away our returns from risk-free assets. And so to find returns, we're having to push out into corporate bonds, from corporate bonds into high yield bonds. High yield bonds, bond yields are down, so we're pushing into equities into riskier equities. So this is been something that's been going on for a long time. And for the central bank to say that they're going to keep interest rates, by the way, to me, that was not a surprise. I don't think to anyone in the market who does this for a living that we expected interest rates to rise anytime soon. My 11-year-old son might get out of college before we see, high interest rates again. So ultimately, this is more of the same. And what it does is, again, I think all it's doing is it's raising the floor under market prices, all sorts of asset prices. But ultimately, that raises the floor, so you have this higher, what I call equilibrium level for market prices. But ultimately, you do need the fundamentals to carry you higher. Good news is that I think earnings will be the next important fundamental support for the market going into the end of this year and into early next year. So Federal Reserve on hold forever. Interest rates are at zero forever, both there, Europe, and Japan. And so that provides, like I say, a higher floor under market prices. But if you don't have if you ultimately don't have earnings come through, that will mean nothing in the long term. For now, it's let's call it temporary extra support.
I just add to that by agreeing with what Myles has said and suggesting that they're taking away the alternatives. And so the one place left for investors to look for any sort of positive return is the equity market, as we've seen over the last couple of years, as we've gone through QE 1, 2, 3, 4, I guess you could call this one 5. And from a technical perspective, we do know that interest rates are used to discount future cash flows of companies, and that's how you arrive at their current day value, or a fair value estimate. So as the denominator in that equation goes down or stays lower, you can see the fair value for shares, when you calculate it, you run your little spreadsheets and whatnot, will actually increase or keep going higher. So that's just one technical side of things to take a look at from that aspect. Thanks for the question.
Well, thanks, Christopher, and thanks, Myles. We're at the top of the hour, so we'll need to wrap things up. And thank you, everyone, for your time, your participation, and your questions. That's it for today. And do remember that within the next couple of days, we'll email you with the link to the video from the meeting. And of course, please share any further questions by email. Take care, everyone, and stay safe.